My name is Paul Bodnar. I represent the necktie industry. Actually, I'm the Director of Sustainable Finance, Industry and Diplomacy at the Bezos Earth Fund, and it is my great pleasure to moderate a dynamo of a panel on the question of capital and how we bridge early stage investment in climate hard tech and get to the point where we're putting steel in the ground, often at billion-dollar scale. So we're going to be talking about that handoff between early stage venture funding and large-scale capital deployment. We're going to be talking about the market signals that trigger investors to move from pilots to deployment and figure out what are the models, the collaboration models among corporates, innovators, financiers, and sometimes governments that can make that possible. So we've got a fabulous panel for you here to talk about that. Immediately here to my left is Brandon Middaugh, who is Senior Director of Microsoft's billion-dollar Climate Innovation Fund, where she drives investments in breakthrough climate technologies and previously also led Microsoft's global distributed energy strategy. Then we have Rama Variankaval, who is the global head of corporate advisory at JPMorgan, overseeing teams focused on finance strategy, M&A structuring, climate transition, ESG, and infrastructure. Okay, I need to pause after that one. Laura Hellman is Senior Vice President at Brookfield Asset Management, which, as you all know, is one of the largest investors at scale in our space, and she specializes in transition and renewable energy investments and will tell us about a very exciting deal that she led last year, I believe. And last, maybe not least, Jigar Shah. Could be least, we'll see. Co-managing partner at Multiplier, LLC, a clean tech advisory firm, but you may know him from his podcast, Open Circuit. And he previously led the U.S. Department of Energy Loan Programs Office, deploying $108 billion for clean energy and transportation projects, founded SunEdison, co-founded Generate Capital, launched the Carbon War Room. So what better group could we have for discussing this interesting topic? So first we're going to talk about getting from 0 to 1 and how we get from venture, which we've talked a lot about here recently, to large-scale infra. And of course, we talk about the valley of death. There are probably several little valleys of death in that larger valley of death between early-stage pilot funding and deployable, scalable financing. So I'm going to ask each of you, from your vantage point and experience, what are the biggest obstacles blocking capital from flowing across that gap? And Jigar, I'm going to start with you. You had this amazing experience overseeing LPO. Tell us what you saw because this was your job, was to deploy capital at scale. What did you see? What was the bridge that you tried to build? And what went right? What went wrong? How should we think about this problem more generally?
Well, I think when you have a working public-private partnership, I do think that there is a major role for coordinating across private sector and public sector and figuring out how you do big things, right? I mean, in our case, it was providing low-cost debt to get to much higher, more stable returns for the equity because we were patient capital, right? So we weren't going to seize control of the assets. We weren't going to figure out how to foreclose on the assets. The goal of the U.S. government is to have these technologies actually stay here, employ people here, right? Scale up here, right? I think that, but when I left office, I talked to over 120 companies, right, that weren't in front of the loan programs office, but just, are great companies. And a lot of what I heard from people is that I think a lot of what we're doing wrong right now in our sector is figuring out where the right time is to exit. So I think there is a laziness in our sector around trying to copy tech models, and it doesn't work, right? Whether it's SaaS or whether it's whatever it is, our models don't have the same trajectory. And so what you find is that the seed stage and the A stage folks, I think, are doing a good job, and they're identifying companies and giving them cash. But a lot of these companies actually just need to be sold after the A round. right? Once you achieve product market fit and once you've got like 2 great customers, like you sort of need to be a part of somebody's catalog, right? You like go into Schneider, you go into Siemens, you go into whatever else, it's $75 million. And what's happened recently is I think a lot of folks have raised all this money because their venture capitalists want to give them more. And then they're like priced out. The people who would buy them are like, we're not going to pay $500 million for you. And so suddenly like they're priced out of the market. They're unlikely to be a publicly traded company because they're not actually like in charge. They're a single point solution. And so we're in this weird spot where I don't think we've done enough soul searching around that valley of death, right? Like part of the valley of death is that there is no valley of death if you're part of a large corporation who sees it as their strategic mission within their like actually catalog management in this moment. There is a valley of death if you're an early stage company who now needs to get $100 million and now needs to burn capital for another 3 years to get to that next level of success. And so part of what we're doing at Multiplier, but also like I'm doing broadly, is investigating what that looks like and how we get entrepreneurs better exits, which oftentimes could be earlier in the process.
So does that mean you think there needs to be more corporate M&A? Because most of the companies are not destined to just go public as freestanding entities, or?
Yeah, I mean, almost all of the companies are not destined to be freestanding entities. I think when you look at the vast majority of these companies, right, they like fix HVAC or they fix like this. I mean, even like companies who have gone public, like Nextracker, you're looking at them and going, should they be independent companies, right? Or should they be part of a larger conglomerate of manufacturing companies, right? I just think that when you think about how these things work, like I think that we just all just default into whatever the tech like sort of supply chain, sort of value chain looks like. And I don't think that works for our businesses. Like some of the things I learned at the Loan Programs Office is the folks who are the best investors in our projects were strategics, right? Like, the Koreans and the Japanese companies, others. Why? Because they didn't care about the return on those particular investments. Like what they cared about is being in like the beginning stages of a transformational technology. And if it worked here, they could take it back to Korea or Japan and like really scale it up and make it a multi-billion-dollar business, right? And for a lot of our growth equity funds, et cetera, I mean, they have to demonstrate 20+% return investments to their LPs, which these projects may or may not be able to do.
Great. So, Rama, I'm going to turn to you on this. Given that your mandate, you have a mandate that focuses on climate and transition, but you have this broader corporate M&A mandate. What do you think of this problem, and what are the solutions?
Well, luckily, we do both M&A and IPO, so I'm indifferent. I think, again, I'm going to take the easy way out and agree with Jigar, mostly. Some companies, I agree 100%, are just really outsourced R&D department. That's what it is. They should realize that that's all they are. They're outsourced R&D for some other large corporate. Their destiny is to just fulfill that role and then become part of a large corporate, 100%. The one maybe additional point I will say is, there are such things as business cycles, and we are in the trough. I don't think we have to be patient. There is nothing we could do. There was a 10-year period when money was free and everything could be funded, and we funded everything, right? Now money is not free, and we are in a different part of the cycle. Risk premiums are a little higher, especially for very long duration cash flows. The discount rate is higher. It's just the valuations don't look great. A lot of VC and private equity sponsor companies, even away from climate, are struggling for exits, right? Because if the vintage was 2019, 2020, 2021, those valuations might be very hard to replicate now and to deliver returns to LPs, exactly as Jigar said. So, and that's a cyclical issue. I think we will get out of it. We need to be patient. And there is this kind of identity crisis, right? Is this a SaaS business model? Some might look like it. And a lot of people started a lot of climate tech looked very sassy. And I think those businesses, I'm personally.
They were very sassy.
I didn't really, not a big fan. Exactly. And some are really infrastructure businesses, but they require so much capital that the venture community is just not the right place. And for banks to step in, we need offtake. There isn't really nothing else works. If you don't have a customer who signed a contract with you, don't bother coming to us. It's just nothing we could do. We like to help, but there's nothing we can do. Microsoft. We love those optics.
The only people, no.
So today we put out our mid-decade market development paper, and it highlights technology, demand, and capital as the core elements of the flywheel, and then you can make it go faster with other things, policy accelerants and so on. But I think that what you raise about the venture and growth challenge of exits today, there's an analogy in infrastructure as an asset class as well, which is we're all of us spending this week talking about this very specific tranche of capital, stage of capital, and how you solve for that. And for the entities that are ready to step into that space, I think, especially if there's an out-of-market risk element, and you're going beyond a pure risk-adjusted return calculation, one of the things that's needed is an opportunity to recycle that capital, an early exit. So I would say takeout finance on the infra side would be my answer to your question, which is once something is partly or largely de-risked and operational, how do you then pull that capital out and be able to put it back in earlier? It could be equity or debt. It depends on that, it depends on the entity you're talking about. This is relevant for strategics, but also for the financial services industry. And so I think from where we sit as both an investor and a buyer, it's really important to create those tools for recycling the capital, and those aren't really used today, and they're not really prevalent in the sort of infra and project space either. I teed you up.
Now so you have this great perspective. You took a brave new technology and you got a $1 billion project to financial close.
$1 billion is the total deal, which includes the framework for future projects.
Okay. Well, so tell us how you got there as a commercial investor.
So I'm going to approach this from the infrastructure lens because that's really how we think about investments. And it's hard to say what exactly, and there isn't a single thing about the Roadrunner project that Infinium is constructing that got us over the line per se. It is the everything from feedstock agreements to advanced enough technology that was commercially operating and demonstrated to advanced enough engineering to the right project site. Importantly, offtake. I think that for me, as somebody looking at that project, was a distinguishing factor. And we talk about offtake all the time, but it really matters, especially in these sectors that are still starting to scale up, where we can't sell SAF at jet fuel prices today. Everybody knows that, I think. So you need an offtake agreement that is at term and bankable with real counterparties. And when we first started looking at Infinium, they had an offtake agreement. And there were other elements of the project that were close to FID but not at FID, and they continue to be able to develop those. But it was exciting for us as investors to be able to see a project that really looked like infrastructure. Mm-hmm. So that really allowed us to get over the line. I think more broadly on this problem of valley of death, I think they're solving for the companies and how they're going to raise capital and what their financing is and making it exciting for founders. And there's also how do we build an ecosystem of projects that work so that we can deploy these at scale and build an actual industry. Because a couple of SAF projects is not going to make the SAF industry work. We need a lot of these projects developed. And so I think whether it's having a corporate fund everything past Series A and they give the development capital, or you raise through Series C and you're able to finance the development capital that way, or you're raising development loans, it doesn't really matter. But as a developer and technology provider, you need to be laser focused on getting your project to look like an infrastructure piece that somebody can come fund with a large scale capital. And maybe that means that it's not on your balance sheet entirely and you're not funding your project through your Series C, D, and E.
So can you tell us about the offtake piece then? How was that solved in this case? And
so I think the first offtake agreement that they got was with American Airlines and Citi.
this is ESAF,
This is
just
ESAF.
and a little E-diesel and E-naphtha, right? Okay. Go on.
Did your homework.
You
It's a
stayed at a
famous
Holiday Inn
project.
Express last night.
Yeah, exactly. And so that agreement is sold to American Airlines, and they're selling the Scope 3 credits to Citi. And that is a partnership that helps finance the project. We also have an offtake agreement with IAG, a parent company of British Airways. But like both of those were very helpful, and the American Airlines City one came first. And so even though it didn't cover the full volume of the facility, it demonstrated that there was a clear long-term demand at a fixed price.
And okay, and how long is that offtake agreement?
10 years.
10 years, right. Well, just to put a plug in for some work that Rama and we did last year, which GMA was also involved in, there's another mechanism, which is the market maker, which tries to solve this offtake problem. And the leading proponent of this has been a nonprofit called H2 Global, which we fund at the Bezos Earth Fund. So if you're interested in understanding how you can make a very muscular intervention in a market and create a pool of capital that serves as the buyer of first resort and the seller of first resort and bridges some of these tenor issues in offtake and price issues in offtake, look up H2 Global and the green market maker model. Just one more question on this round. So we started, Jigar, with you saying we may have learned we've learned the wrong lessons from tech or other sectors. This sector is not like other sectors, and we might do it differently. Why is it not like other sectors? How is it not like other sectors in relation to this particular problem we're talking about? Because
in the end, the upside is not infinite, right? Like when you're working in something where you're getting advertising dollars, right? I mean, that's basically what all tech companies do. And then ultimately, like you're in a greenfield space and your upside is infinite. That's great. But in our space, like there actually is a price for avgas. There's a price for steel. There's a price for cement. There's a price for all the things that are up here, right? And so Brandon might be able to pay 2x the cost, but she's not going to pay 12x the cost. Or if she does, it's like a tiny, tiny amount of like volume, right? And so in the end, no matter what it is that you're doing in our space, there's only so much wealth creation that can be created by your, innovation, right? And so then the question becomes, how do you stack the capital to make sure that everyone has enough room to make money, like within the value creation that is allowed for within the offtake agreements, right? And at some point, you need the cost of capital to be lower, right? like that's just it, right? And so then the question is, for that next round of capital that has a lower cost of capital, what do they want to see to get involved? Right? They might want to see product market fit in the first two customers. They might want to see an offtake agreement. They might want to see, like a big pipeline of conversations. Whatever it is they want to see, and then what you end up with is, sort of like a lot of companies. I mean, I don't have to name them just because I don't want to shame them, but like there are a lot of friends of mine where they took a big, slug of capital from Warburg Pincus, or they took a big slug of capital from this group or that group. And then they sold the company 6 years later. And guess what? The valuation for them personally was exactly the same 6 years later. And I was like, so you worked for free for 6 years? They're like, yeah. That sucks, right? That sucks, right? And so they could have sold it 6 years earlier and then made it Warburg's problem, right? To figure out how to scale that business to the next level. Or they become like a CEO of that entity that Warburg owns, right? They've already gotten a mini exit, and now they have performance-based bonuses to meet whatever it is that that company has to meet in terms of size and putting capital to work or whatever. But now their family has their mortgage paid off. I just think that in this space, we have for so long talked about doing well by doing good, and we have done so much good, and we have not delivered on the doing well part.
I think maybe if I can add, it's a combination of capped returns and need for very high quantum of capital.
Yeah.
Right? It's a combination, right? That kills the sector.
Mm-hmm. Okay. Brandon, you mentioned something earlier that you're both a buyer and an investor, right? So in some ways, I could see that it's easier to be a buyer, right? You can say, well, if you build it, I will come, right? If you supply it, I will buy it. I'll back these different sector efforts. But as an investor, right? How do you think about the difference between your role as a buyer, as a procurer, and as an investor in these technologies?
In an ideal world, a corporation like Microsoft would be able to sign one of the bankable contracts that we were just talking for offtake, and then send that company, that counterparty to the banks. And in some cases, that works and that is sufficient, especially in some de-risked sectors or sectors where there's a long history of institutional capital participation. And we could talk about the JPM Chestnut Carbon as an example there. I think in other emerging sectors, we have to be more involved in how we participate. And certainly in a lot of the work we're doing on sustainable materials, sustainable fuels, it requires novel offtake contracts. We are both buying physical steel from Stegra, everyone see Johan afterwards, as well for our suppliers, as well as buying environmental attribute certificates for that. And we are an investor. And so I think in some of these emerging sectors that you were hearing about in the sessions earlier, it's really important for the strategics to get involved and have a high degree of alignment when they're building out these novel contracting mechanisms.
Would you guys like to talk for a minute about the Chestnut Carbon project?
You should, because it's
We love
awesome.
talking
Well,
about
I just raised it because we just had a panel or we had a discussion about advanced market commitments. And the interesting thing about carbon removal, unlike some of the other commodities and sectors we're talking about, is that these are demanded in the real economy, right? People need steel, they need cement, they want trucking services and aviation services and shipping services. But carbon removal is tougher because it's not a product that has a natural value in the real economy. So from an offtake perspective and from a valuation perspective, I imagine it was especially interesting for you guys. So do you want to tell us a little bit about it?
So carbon removal CDR company called Chestnut, project developer, Microsoft was the off-taker, I believe 25-year off-take contract. And again, if you step back, pretty much all of these carbon removal companies or carbon companies are 100% equity financed, right? And the cost of capital issue is very, very problematic. It's very expensive. So the idea was, how do we bring down the cost of capital? And again, we tried to take the project finance model and take this contract. And again, Microsoft and Chestnut were kind enough to bring us in very early when they were still negotiating the contract, so we could give suggestions on how to make the contract actually bankable before it was kind of inked. So we did that, and they did that really. We were kind of giving suggestions on how to kind of tweak the contract. And then again, there are several specific things. Again, 25-year contract is fantastic. Microsoft as a counterparty is fantastic. But Chestnut itself is a very, very credible management team owned by Cambridge. So we know that side as well. That was very important. It was, again, the leverage ratio, the debt service was very healthy, so we did not over-lever. There were a variety of project milestones. And so we tied our financing to all the milestones that Microsoft was demanding of Chestnut, right? That we will sign more offtake if you buy more acreage or buy the seedlings. And we said, okay, we will release more funds when you do those exact same things. So we were able to kind of connect those two things. And then just some characteristics of the project were very helpful. So I think the land is spread over 7 or 8 states. So it helps us from kind of risk management perspective. If there is a fire, it's not like the whole thing is going to go down. We were able to convince some insurers to come in and provide us a backstop because there was some risk that Microsoft did not want to take, JP Morgan did not want to take. So we were able to kind of get insurance to take some of that risk. So I think it's fair to say we all kind of went a little outside our comfort zone to make this work, and it's only about $210 million of debt financing, and the only reason we spent months and all the time is because I think this is replicable, right? I think this sets the template for taking a otherwise quite difficult to finance contract and make it financeable. So we've been kind of quite actually interested. Of course, the other big thing is we can't just have CDRs as a trophy asset or any of these things, green steel, SAF. It can't just be a trophy asset that one or two guys want to buy. It has to be an asset everybody wants to own, right? And Microsoft obviously is great, but we are talking to consumer companies, industrial companies, other tech companies. Number of people are now interested, now that there is the mousetrap of how to finance it and bring down the cost of capital. We're getting a fairly good traction, I think. What do you say?
One of the things I love about the Chestnut transaction is the shared diligence. And I think that is a generalizable function that I hope will be replicable across not just the carbon removal space, but some of these other sectors as well. Our teams do a tremendous amount of technical diligence, sustainability diligence, financial diligence, and so on. And to share that with a banking partner and then help that be part of what builds the bridge to bring them in, I think that's something that's really important as you're looking at these sectors too.
Yes.
I mean, the other thing that's valuable here, though, is to Rama's point and to Laura's point, like, is it, I mean, this is a really high-quality team that have built, like, LNG assets, like natural gas assets, et cetera. They actually knew how to do a project finance deal, which is great, and they got DBL to invest into the round, et cetera, right? And I think, and so, like, I mean, one of the big challenges that I see right now is that there actually are, like, a certain number of teams that actually have this expertise. It's actually not infinite, and it's certainly not most of the 5,000 people who got venture capital since 2017. And so, you know, part of the challenge is, like, you know, do we expect these teams to actually gain this knowledge? I doubt it. So then how do they rent this knowledge, right? And is that, like, strategic hires that they're making that actually have this experience, or are there, like, you know, teams that they can partner with so the checklist that they're pursuing gets to, you know, what Laura needs?
So, Laura, a question for you on this. Feel free to weigh in on this too. But as a big infra investor that's done a lot in this space, what relevance do buyers alliances, advanced market commitments, and the sort of demand pull, demand aggregation side have for your willingness to underwrite deals?
It's extremely important to have these associations. It is very, very helpful. And it sends the right signals to get the companies formed and starting to develop their technology. It gets early investors willing to fund the development capital. Importantly, like, these need to translate into bankable long-term offtake agreements as well in order for the projects to fully get built. If we're talking hundreds of millions of dollars or $1 billion on the line, because nobody's going to put up that money purely based on a market signal, but you need the market signal to get it catalyzed. So it's extremely important, but it also needs to come with real term offtake contracts and feedstock contracts, if that's relevant. You need EPC contracts. You need the full thing to be infrastructure. And one point you made that was super relevant and important is the replicability of these projects. Like, we don't spend the time looking at something to put $100 million into it and then call it a day. We're spending time looking at scaling these technologies because we believe that there's a path to scale them, so that we can invest $1 billion or $2 billion and somebody else can do that and we can develop an entire industry. So you want to create something that can be done and is replicable.
Well, I mean, to your point, the EPC contracts, we reviewed hundreds, right, during the Loan Programs Office, were in general in terrible shape every time we saw them. And it is another thing that I think Breakthrough Catalyst tried to, like, bring some of that discipline into some of that. But I think it's a huge problem, and for some of the projects that we've had the most trouble with out of the Loan Programs Office, there were, you know, one-sided risks that the companies were taking that they didn't really realize. And, you know, ultimately didn't have the quality construction team in-house to manage those risks. And so then when costs ballooned, they didn't really know what to do about it. They couldn't raise more equity, and then, you know, the whole thing falls apart. I do think that whole EPC thing is hard because we don't actually have amazing EPC contractors in the US. Like, we do from a solar and wind perspective, but, like, when you look at Kiewit or Mortensen or, like, some of these other companies, they're not experts in building, like, Monolith Materials' OC1 plant or, you know, all these other things. So you've got, like, startups like Unlimited Industries that Andreessen Horowitz is back to try to, like, you know, figure out a way to fix that, figure out how to get better feed studies, better cost studies, et cetera. But it is not a practice that we're good at as a country in terms of actually getting proper EPC wrapped projects.
Okay, I'm going to ask you guys each the same question. I'm springing this question on you, and then if we have time for a couple audience questions, we'll do that. When you think of, besides the projects we've mentioned, the Infinium Project Roadrunner and Chestnut Carbon Project, what is a deal that you've seen recently that you find exciting in terms of how it's trying to innovate and solve some of these financing or structuring problems? Who would like to go first?
Can I take an easy one and say
Yeah.
the Stegra deal is really exciting?
Yeah, she's,
The Stegra deal, green
Yeah,
steel.
yeah.
I'm excited about green steel, and I think it's been a market that needs to develop, and getting offtake contracts in the steel industry is very hard. And so I think
Yeah.
it's really creative.
yeah, and I'm happy to yes and that one. I think that with Stegra, one of the interesting things was learning from other sectors. In carbon removal, we're a large part of the end market, but in steel, we're quite a small part of the end market. And so learning from the automotive sector on how to bring offtake contracts to bear in a very multi-layered supply chain is super interesting. This is a pair of offtakes where we're combining both physical supply for the suppliers and then environmental attribute certificates, and thinking about how those two combine to provide the bankability that Stegra needs in order to build their plan.
And this is one of the first to do that, right?
Yes.
Yeah, okay, great.
Slightly out of maybe scope, perhaps, is this deal with MP Materials. Have you heard of that? No. This is in the rare earths magnet space. It's a mining company, right? The only off-taker better than Microsoft that I know of is the U.S. government. And we were representing MP Materials, so we
I'm
were
just
happy.
saying, Epi Materials has never processed rare earths before. They've never made permanent magnets before. No one is ever going to buy them. And we're in this weird spot where we're like celebrating.
Jigar, these two agreed. We don't have to disagree. You can agree with me.
I'm just saying, like, we're destroying the entire marketplace right now. Like, if you're in the rare earths permanent magnet business, would you possibly like want to compete with the U.S. government right now?
Well, the U.S. government has always picked winners and losers. That's something they've done. But the point is finding an off-taker. And again, MP Materials, right now there is obviously energy security is what sells. Right? And if you are in the business of providing energy security, how will you define it? I think that is a massive advantage right now when there is a ton of capital. Right? And again, I think MP Materials, whether you're on the side of Jigar saying it's a bad deal or not, it sets a template. Right?
What's innovative about it?
The U.S. government provided an offtake, right? And a price floor.
For the entire volume?
For the majority of the volume, right? And also provided, again, this is where I think Jigar is probably going, they provided essentially guaranteed EBITDA to the company. Right? So that is, again, very generous. And maybe they will replicate it, maybe they won't, but the idea is the US government cares dearly about energy security, and there are lots of things in the, the critical mineral space, in the mining space, which I think would qualify.
Sounds like a defense sector deal.
I don't think so. A lot of these are kind of used in climate tech. A lot of the input.
Jigar, what would you nominate?
So I'll maybe have
MP Materials is taken.
Yeah. I'll definitely not be bringing that one up. I think maybe I'll do a little bit of a throwback. I think when I was at Generate Capital, we put several $100 million behind anaerobic digesters, right, and are now the largest food waste digester operator in the United States and Canada. I think even with that work, which is one of the things I was talking to Dave Roberts and Clay about with my question, is that like it sort of stalled, right? I mean, if you look at all of the industrial food companies in the country that have already made mandates to not put their food waste into landfills because of their Scope 2 and Scope 3 emissions, and they want it processed, we're short 40 digesters just for them to actually process all of their food waste in Canada and the United States, right? I'm sure these guys would love to fund it. I'm sure lots of other people would love to fund it. But even though we've got, 5 or 7, of these already built, we're not getting the next 30 built. Like those offtakes are not going into place. The construction's not happening. The processing is not happening. Well, the feedstock is already, the industrials have said that they want to take it somewhere. They're not going to give you a 20-year feedstock agreement because they don't know how much waste they're going to have per year. But they're like, we're going to give you all of our spoiled ice cream or whatever it is that they give you, right? I know that the Generate Capital facility in Cayuga just processed a bunch of mislabeled White Claws. So I think that, but I think it's something that I worry a lot about is that, from the Loan Programs Office perspective, we did all these first-of-a-kind deals, which I'm very proud of. But the point of it is actually to get to gigaton scale, right? The point of it is not to stop at 5 or 7 units, right? And I worry that we're not spending enough time thinking through like what's causing these things to stall out after the first 5 or 7 of them got built. NextEra bought the more dairy digesters, and then BP bought more dairy digesters, et cetera. But like I think it's stalled out now. Like we're not.
And why has it stalled out?
I don't know exactly, but I think some of it is enthusiasm, right? So some of the industrial companies are like, well, I got 5% of my stuff into the thing, and like I've checked that box, and like it's not clear that I actually want to like put a full-time person on getting it to 100%. And some of it also could be like, crazy people in New York who like, listen to like some crazy Cornell professor who hates all RNG, right? And so now we finally got that fixed last week, but it took 7 years of work to fix that, right? Michigan, right? Like some old Sierra Club person basically created a fake Facebook page, which then caused the digester to shut down prematurely. And so like part of this is like there's real risk, right? Like, I mean, you think about it as infrastructure for 25 years and then, something bad happens and then it creates a shadow over the industry, right? And so like one of the things that I care deeply about is whether the stuff that we're doing in the first 5 to 7 plants like actually then scales to 100.
Yeah, we're just over time, but please do, just.
So there's more to connect back to the earlier panels where you have off-takers who can't get credit in the greenhouse gas system for the companies that you're trying to
Well,
buy,
that's right. The
So
protocol,
they have a
book and
bunch of
claim.
Systematic issues. It's not just, it's the things you talk about and more.
Oh, totally. And what he's talking about is the WRI-led, well, it's actually spun off now, but the greenhouse gas protocols, where the book and claim like process itself is now being, like contested not just within that process, but like the entire government of Canada is now questioning book and claim, right, for their credit process, right? And you're like, what are you doing? Book and claim by definition means you can't double count it. They're like, well, we're not sure. And so it makes it difficult to like figure out what the actual offtake agreements look like.
Okay, well, I'll just close by saying that you mentioned spoiled ice cream, something that.
That's Unilever.
Yeah, well, someone told me yesterday, just remember, institutional investors only like vanilla ice cream. So
I don't know, Paul. It's a bit of a rocky road.
All right, please join me in thanking the panel.